All right, let's talk about insurance. You've got a policy, right? But have you ever really thought about who's on the other side of that deal? We're about to pull back the curtain on the entire insurance world. We'll meet everyone, from huge corporations to, believe it or not, groups of people just like you and me. Let's get into it. Yeah, I mean, that piece of paper you have tucked away somewhere, it's a promise, right? A promise to be there when things go wrong. But who is making that promise? Is it some giant company in a skyscraper? A nonprofit? Could it even be the government? You know, the answer isn't as straightforward as you might think. Okay, before we really get going, let's just make sure we're on the same page with the lingo. The insurer, that's the company providing the coverage. The insured, well, that's you, the person who's covered. Easy enough? Now that we've got the basics, we can really start our tour. So, here's the game plan for our little tour. First, we'll tackle the big split, public versus private. Then we'll get into the nitty-gritty of stock versus mutual companies. From there, we'll check out some unique group insurers, peek behind the curtain at how insurers insure themselves, and wrap up with the specialists who handle the really wild stuff. All right, first stop. This is really the most fundamental divide in the whole insurance universe. Pretty much every company you'll ever encounter falls into one of two main buckets. They're either private or they're run by the government. And believe me, the difference between these two is night and day. It really comes down to their core mission. Private insurers, well, they're businesses. They're designed to make a profit. But government insurers are totally different. Their goal is to serve a social purpose, to provide a safety net. So, what are we talking about when we say social purpose? Well, think about risks that are just massive, so huge that no private company could ever hope to cover them. Things like widespread flooding or even the risks associated with war. The government steps in for those. And of course, they run the big social programs we all know, like Social Security and Medicare, and even things like federal crop insurance for farmers. Okay, so let's leave the government world for a bit and jump over to the private side of things. This is where most of us get our insurance. And here, the landscape is dominated by two types of companies, stock companies and mutual companies. The big question that separates them is a simple one. When the company makes money, who gets to keep it? Okay, check this out. A stock company is pretty much like any other publicly traded business. It's owned by stockholders, investors who buy shares, and if the company does well, the profits go to them. A mutual company, on the other hand, is a whole different ballgame. It's owned by, wait for it, the policyholders. That's right, the customers. So if there are profits, they go back to the customers. It's really the difference between just shopping at a store and being a member of a co-op. And this leads to a really key piece of jargon you might see. If you have a participating policy, often called a par policy, it means you get to participate in the company's success. You might get dividends, maybe even vote for the board. But if your policy is non-participating or non-par, well, you don't. You're just a customer. That's the bottom line. And get this isn't a permanent choice. Companies can actually switch sides. A mutual company can decide it wants to raise a bunch of cash by selling stock to the public. That process is called demutualization. It's way more common than the other way around, but sometimes a stock company can become a mutual one. That's called mutualization. Okay, on to our next stop. Now we're talking about a whole category of insurers that are basically like exclusive clubs. You can't just buy a policy, you have to be a member. And to be a member, you've got to share some kind of common bond with everyone else. A perfect example of this is a fraternal benefit society. Think of groups like the Knights of Columbus. These are nonprofit organizations, and they have this whole lodge system. They offer insurance, but only to their members, who are all connected by, say, a shared faith or heritage. It's insurance, but with a social and charitable mission built right in. All right, listen closely, because these next two sound super similar, but they are fundamentally different. A risk retention group, or RRG, that's where a bunch of people with the same type of business, let's say a group of architects, get together and form their own insurance company. They are the insurer. Now, a risk purchasing group, or RPG, is different. That's more like a buying club. The architects get together and use their group buying power to go out and get a better deal from an existing insurance company. See the difference? One is the company, the other buys from a company. And then there's this other model that's really cool and kind of old school, the reciprocal insurer. This is wild. It's not even technically a corporation. It's just a group of people, or subscribers, who all agree to insure each other. They literally pool their money to cover each other's losses. It's about as close to a true peer-to-peer insurance system as you can get. Okay, now we're going to go backstage. We're going to look at a part of the insurance world that is absolutely massive, but almost nobody ever thinks about it. So, what happens when an insurance company itself gets nervous? When they've sold so many policies that one big disaster could sink them? Well, they do the exact same thing you do. They buy insurance. Yep, it's called reinsurance, and it is literally insurance for insurance companies. It's a way for your insurer to offload some of their risk onto an even bigger company. This way, if a hurricane hits and they have to pay out billions in claims, they don't go out of business. The reinsurer helps cover the tab. So the process is pretty straightforward. Step 1, you buy your policy from what we'll call the primary insurer. Step 2, that insurer then turns around and transfers a chunk of that risk to a reinsurer. Now, the primary insurer doesn't give away all the risk. The piece they decide to hang on to is called their net retention. This whole system is the hidden scaffolding that keeps the entire industry standing. All right, for our last stop on the tour, we're heading into the weird, wonderful, and sometimes wacky world of the specialists. These are the folks who step in when the risk is just too strange or too big for a regular insurance company to even consider. This is where you find some fascinating stuff. You've got surplus lines insurers. Need to insure a priceless piece of art or maybe a pro golf tournament that has to pay out $1 million for a hole-in-one? That's them. Then you have service providers, which are a bit different. Think about your HMO or PPO. They're not just paying bills, they're actually providing the healthcare services themselves through a network. And then there are industrial insurers, a throwback model that offers small policies, sometimes called burial insurance, where an agent might actually come to your house every week to collect the premium in cash. And of course, you can't talk about special risks without mentioning the legendary Lloyd's of London. But here's a crucial thing most people get wrong. Lloyd's is not an insurance company. Not at all. Think of it more like the New York Stock Exchange, but for risk. It's a physical marketplace where different groups of underwriters, called syndicates, come together to bid on insuring really complex things, like a satellite launch or a celebrity's voice. It's a place, not a company. So there you have it. We've been all over the map, right? From government safety nets and shareholder-focused stock companies to customer-owned mutuals and these super specialized groups. It kind of leaves you with the big question, doesn't it? When it comes to managing risk, what's better? A system built for profit or a system built for people? I don't think there's a simple answer, but it's definitely something worth thinking about the next time you pull out your own insurance policy.